for the non-farm payrolls for released on August 5th for the month of July, July 2016. In theory, the Federal Reserve is data dependent and it has two mandates, employment and inflation. Inflation used to be a worry, and then now it's not that much of a worry, but jobs became a worry of late, especially with the terrible report in April and in May. May saw, according to the revised data, only 11,000 jobs gained. But on the other hand, we had in June, we had 287,000 jobs gained. So a big compensation, but what exactly is going on? We got used to very stable reports, around 200, even a bit higher, but relatively within expectations or not huge surprises. Now we had 2 months, even 3 months of big surprises. Okay, so markets are expecting a return to stability. 180,000, just under the 200 magic number. Okay, wages are expected to rise 0.2% month over month. Last time, the month-over-month figure was disappointing with only 0.1, but the year-over-year was okay with 2.6. I believe with 0.2, wages used to be more important until the last 3 months. I think now the headline figure returns to its headline role as being more important. If we'll have, I believe, above 200,000 for a second month in a row, it'll be good for the dollar, it will help it recover. We don't need much above 200,000. We don't need a big beat. We just need more stability, more certainty after those terrible months of April and May. If we have another disappointment, another move, well, under expectations and especially under 100,000, it'll be devastating for the dollar, joining on the heels of bad GDP, bad durable goods orders, general feeling of a slowdown. Okay? Remember, if we might have a good headline report but poor wages, or the other way around, and we could have big revisions as well. So as always with non-farm payrolls, trade with care and watch out for sometimes the first reaction is not the correct one. The dollar could rise initially but then crash, or fall down and then rebound quite strongly. So it's not only the headline number, but this time it's the most important thing, okay? After a few months that wages were more important, okay? Unemployment rates, this is more important politically because we know that the unemployment rate depends on the participation rate. So those trading markets will probably ignore it. I mean, if they see the unemployment rate rising, but the participation rate rising, it's actually good news because more people are into working, are jumping into the job market. And if we'll have a fall in the unemployment rate to even lower levels, but the participation rate falls, it'll be ignored by markets, okay? It means that it's actually bad news, okay? But for politics, it does matter, the headline figure, because, well, Clinton is running on the Obama ticket, and, well, she's sort of the incumbent, and better data, but lower unemployment rate is better for her. Higher unemployment rate is good for her opponent, Donald Trump. In any way, the US dollar enters this event on the back foot, on the heels of weak figures in the United States. We'll need a good report to stabilize it, to help it recover. And if we'll have another weak report, it'll hit the dollar hard. So the risk is asymmetric, more risk to the downside with the current bias. All right. But remember also today's figures, non-farm payrolls, ADP non-farm payrolls and the ISM non-manufacturing PMI will have an impact on shaping expectations.